want to tell you about the single most boring financial strategy ever documented. No stock picks, no market timing, no earnings calls, no weekend research sessions, no alerts on your phone, no spreadsheets updated weekly, no financial news consumed with breakfast, no advisor meetings where someone explains why last quarter underperformed. Just a number growing, quietly, on its own, while you live your life. A $100,000 portfolio becoming $1 million, not in some aggressive high-risk scenario, not in a bull market outlier. In a completely ordinary market environment, with a completely ordinary investment strategy, managed by someone doing almost nothing beyond the initial setup. And the uncomfortable truth that most of the financial industry is built around hiding from you is this: the laziest version of this strategy outperforms the most active version, not occasionally, not in certain markets, but consistently, over every meaningful time horizon that has ever been studied. The people who check their portfolios daily do worse than the people who check them annually. The people who check annually do worse than the people who check every 5 years. And the people who forgot they had an account entirely have, in documented studies, outperformed everyone else. I am not making that last part up. I am going to show you the research. But first, let me show you two people who both started with $100,000. Because the gap between what happened to them is the most clarifying financial data I have ever put in front of a viewer. Meet Priya. Priya is 35 years old. She lives in Denver, Colorado. She works in healthcare administration. She is intelligent, ambitious, and genuinely interested in personal finance. She listens to financial podcasts. She reads investment newsletters. She follows 3 different market analysts on social media. When the market moves significantly, she reads the explanations carefully and thinks about what they mean for her portfolio. At 35, Priya has $100,000 to invest. She is not reckless. She is not a gambler. She just believes reasonably that being informed and attentive about her money will help her make better decisions than being passive. Over the next 10 years, Priya adjusts her portfolio 7 times in response to market conditions and analyst recommendations she finds credible. She moves to more defensive positions twice during corrections. She shifts toward growth sectors twice during recoveries. She rebalances quarterly, as recommended. She pays a 0.65% annual advisory fee to a robo-advisor that manages her actively shifted strategy. Priya is doing what most informed investors do. She is engaged, she is attentive, she is trying. Now meet Derek. Derek is also 35. He also lives in Denver. He also has $100,000. He works in IT and has almost no interest in financial markets. He knows nothing about sector rotation or earnings calls or yield curve interpretation. He does not follow any market analysts. He does not read investment newsletters. He has no financial news alerts on his phone. What Derek has is a single piece of advice he received from his father at age 27, written on a note card that he keeps in his desk drawer. The note card says, "Put the money in a total market index fund. Set up automatic monthly contributions. Do not touch it for 20 years. Everything else is noise." Derek invested his $100,000 in a Fidelity Zero total market index fund. Annual fee, 0%. He set up an automatic $500 monthly contribution from his checking account. He has checked his balance 4 times in 10 years. Twice because his wife asked how things were going. Once because he needed to pull up the account for a mortgage application. Once out of idle curiosity. He has made 0 changes to his portfolio in 10 years. 10 years after both Priya and Derek invested their $100,000, here is where they stand. Priya's portfolio: approximately $218,000. Annualized return after fees and the drag from her 7 tactical adjustments: 8.1%. Derek's portfolio: approximately $249,000, not counting the monthly contributions. Including the monthly contributions, approximately $321,000. Annualized return: 9.7%. Priya worked harder. Priya paid more attention. Priya made more informed decisions. Derek did almost nothing. Derek is $103,000 ahead of Priya. This is not an anomaly. This is the central finding of nearly every long-term study of individual investor behavior ever conducted. Activity destroys returns. Attention, applied to investment decisions, is almost always negative in its impact. The investor who does less wins. Let me show you why this happens, because the mechanism is not obvious until you see it clearly, and once you see it, you cannot unsee it. The average investor in an actively managed fund earns significantly less than the fund itself earns. Not slightly less. Significantly less. A landmark study by Dalbar, which has tracked this gap for decades, found that over a 20-year period, the average equity fund investor earned approximately 4.3% annually, while the S&P 500 index returned approximately 9.8% over the same period. The fund was available to them. They had access to those returns. They simply did not receive them because of the decisions they made in response to market movement. When markets fell, they sold. When markets recovered, they bought back in at higher prices. The timing was consistently wrong because the timing is always consistently wrong for human beings making decisions based on emotions triggered by market volatility. The gap between what the market returned and what investors actually captured is called the behavior gap. It was named and documented by financial planner Carl Richards, and it explains almost everything about why most investors underperform the market they are invested in. The behavior gap is not a character flaw. It is not stupidity. It is the predictable output of human psychology applied to financial decisions in an environment designed to trigger emotional responses. Financial news is not designed to inform you. It is designed to generate engagement. Engagement is generated by urgency, by fear, by the feeling that something important is happening right now that you need to respond to. A headline that reads, "Market slightly higher on low volume, no action required," does not generate clicks. Is this the beginning of a major correction? Generates enormous traffic, regardless of whether the correction materializes. The financial media ecosystem, the television networks, the newsletters, the social media analysts, is structurally incentivized to make you feel that attention and action are required. Passivity does not sell advertising. Urgency does. Every time Priya consumed financial news and felt the pull to respond, she was interacting with the system designed to make her feel that pull. Every response cost her money. Derek never felt that pull because Derek never consumed that content. His ignorance was not a weakness. It was, in a very specific and measurable sense, a structural advantage. Now let me show you the actual mechanics of the strategy. Because the laziness is specific. It is not random in attention. It is a deliberately designed system that produces excellent outcomes, precisely because it removes the human element from the process as completely as possible. Step 1 is the fund selection. And this is where almost everyone overthinks. A total market index fund holds every publicly traded company in the United States, weighted by market capitalization. When you own a total market index fund, you own a small piece of Apple and Microsoft and the largest companies, a small piece of every mid-sized company, and a small piece of every small company. You own the American economy, all of it, in proportion to its size. When a company grows and its market value increases, your share of the economy grows with it automatically. When a company shrinks or disappears, it becomes a smaller piece of what you own, automatically. No decision required. No research needed. The fund rebalances itself. The total return of a total market index fund is, by definition, the total return of the American stock market. You cannot do better than the market with this fund. You also cannot do worse. You get exactly what the market gives, minus the fund's fee. At Vanguard, Fidelity, and Schwab in 2026, that fee is between 0 and 3 basis points. On $100,000, the maximum annual cost is $30. $30. To own a proportional stake in the entire American economy. Compare this to the average actively managed mutual fund fee of 0.68% annually, which on $100,000 is $680 per year, and the actively managed advisory relationship, which runs 1% or more, which is $1,000 or more per year. All of that additional cost goes toward an attempt to beat the market that, according to every major long-term study, fails approximately 87% of the time over a 15-year horizon. You are paying more money for a worse outcome. That is the math of active management, compressed to its essential truth. The fund selection for the Lazy Millionaire strategy is one decision, made once, never revisited. Total Market Index Fund. Done. Step 2 is automation, and this is the mechanism that makes everything else work. The reason most investors underperform is not just that they make bad tactical decisions. It is that they make inconsistent contributions. They invest when they feel good about the market. They pause when they feel nervous. They stop entirely during recessions, which are exactly the periods when new contributions buy shares at the lowest prices. Automation removes the decision entirely. A standing instruction to transfer X dollars from your checking account to your investment account on the same day every month, regardless of what the market is doing, regardless of how you feel about the economy, regardless of what every analyst on television is saying, produces two enormous structural advantages over manual investing. The first advantage is consistency. You invest through crashes, through corrections, through recessions, and through booms. Your contributions buy more shares when prices are low and fewer shares when prices are high. This is called dollar cost averaging, and its power is not that it guarantees good entry points. Its power is that it eliminates the human tendency to time entries, which consistently worsens outcomes. The second advantage is inertia. An automated system continues operating whether you are paying attention or not. In a crisis, when emotions are highest and the urge to stop investing or sell is strongest, the automated instruction keeps running. Shares keep being purchased. The investor who could not stop themselves from selling in 2020 locked in losses. The investor whose automatic transfer ran on its scheduled date in March 2020, the single worst week of the crash, bought shares at prices that nearly doubled within 18 months. The automation does not require wisdom. It requires only that you set it up once and do not cancel it. Step 3 is time. And this is the one that most people intellectually understand and emotionally underestimate. There is a calculation that changes how most people relate to money once they truly internalize it. It is called the Rule of 72. Divide 72 by your expected annual return. The result is the number of years it takes for your money to double. At 7% annual return, your money doubles every 10 years. At 10% annual return, it doubles every 7 years. The S&P 500 Total Market Index has returned approximately 10.4% annually over the last century. Adjusted for the fee of a zero-cost index fund, your effective return is essentially 10.4%. At 10.4%, your money doubles every 7 years. A $100,000 portfolio, with no additional contributions, growing at 10.4% annually. After 7 years, $200,000. After 14 years, $400,000. After 21 years, $800,000. After 24 years, approximately $1 million. Without adding a single dollar beyond the initial $100,000. Without making a single investment decision. Without checking the account more than once a year. Simply by letting time do what time does when money is invested in a total market index fund and left completely alone. Now add the automatic monthly contributions. At $500 per month starting at age 35, the same $100,000 reaches $1 million not in 24 years but in approximately 18 years, by age 53. At $1,000 per month in automatic contributions, the crossing happens at approximately 15 years, age 50. The contributions do not require additional decisions. They do not require monitoring. They transfer automatically on a schedule you set once and forget. They are mathematically predictable in their compounding impact, and they are psychologically effortless once the system is established. This is the laziness that works. Not the laziness of indifference, but the laziness of a system so well designed that it requires nothing from you except the initial setup and the discipline not to interfere with it afterward. Let me show you what interference costs, because this is the part that most investors experience personally, and almost no one quantifies explicitly. Priya's 7 tactical adjustments over 10 years did not just cost her the direct fee impact. Each adjustment involved selling some assets and buying others. Each sale created a taxable event in her non-retirement account. Each purchase reset her cost basis. The tax drag from her tactical activity reduced her effective annual return by approximately 0.4% per year, a number that sounds small and compounds into something that is not. On top of the advisory fee of 0.65% and the tax drag of 0.4%, Priya's total drag relative to a passive index approach was approximately 1.6% annually. Over 10 years on a starting balance of $100,000, that 1.6% annual drag compounded into approximately $41,000 in foregone wealth. Priya did not lose that money to a scam. She did not lose it to a market crash. She lost it to the entirely predictable cost of trying, of paying attention, of being an engaged investor in an environment designed to monetize her engagement. The financial industry's entire revenue model depends on investors believing that engagement is valuable. The research consistently shows the opposite. Every additional decision an investor makes is, on average, a decision that costs them money. Derek made 0 additional decisions. His $0 decision-making cost was his structural advantage. Now let me address the objection that almost everyone raises at this point. because it is a legitimate question and it deserves a direct answer. What about downturns? What about 2008? What about 2020? What about the possibility of an extended period of poor market performance that makes the whole strategy fail? The total U.S. stock market has experienced significant drawdowns throughout its history. The 2000 dot-com crash saw the market fall roughly 50% over 2.5 years. The 2008 financial crisis saw the market fall approximately 57% peak to trough. The 2020 COVID crash saw the market fall 34% in roughly 5 weeks. In every single one of these cases, the market eventually recovered and went on to reach new highs. The 2000 crash took about 7 years to fully recover. The 2008 crash took about 5 years. The 2020 crash took about 6 months. The investor who stayed invested through all of these, who did not sell at the bottom, who did not pause contributions, who simply left the automated system running, captured the full recovery, plus the growth that followed. The investor who responded to each crisis, who moved cash, who reduced contributions, who felt the urgency of the financial headlines and acted on it, locked in losses at the worst possible moment and then bought back in at higher prices once the recovery felt safe enough. Derek's automated transfer ran every month through the 2020 crash. He did not know the market was down 34% because he did not check. His contributions in March 2020 bought shares at prices that recovered to double their value within 18 months. Priya knew the market was down 34% because she followed it daily. She paused her contributions for 4 months. She shifted to a more defensive allocation. She missed the sharpest recovery in modern market history. Both investors were in the same market. One was protected from himself by his own indifference. The other was exposed to herself by her own attention. There is one additional element of the lazy strategy that most people overlook and that produces significant, measurable wealth over a long time horizon. It is called tax location, and it requires 3 decisions made once, never revisited. The first decision is to put as much money as legally possible into tax-advantaged accounts before investing anything in a taxable account. In 2026, the 401k contribution limit is $23,500, with a $7,500 catch-up for those over 50. The Roth IRA limit is $7,000, with a $1,000 catch-up. A married couple maxing both a 401k and both Roth IRAs can shelter $62,000 per year from future taxation, completely legally, using accounts that have existed for decades, and that the financial industry vastly underutilizes on behalf of its clients, because the products inside those accounts tend to be simpler and lower fee than the products outside them. The second decision is fund selection within those accounts. The same total market index fund. 0 to 3 basis points. Nothing else. The third decision is Roth versus traditional, which depends on whether you expect to be in a higher tax bracket now or in retirement. If you expect to be in a lower bracket in retirement, traditional pre-tax contributions let you defer the tax until then. If you expect to be in a higher bracket in retirement, Roth contributions mean you pay the tax now and the money grows tax-free forever. For most people in their 30s and early 40s, the combination of a traditional 401k and a Roth IRA captures both benefits simultaneously. The 401k reduces taxable income now. The Roth grows tax-free for retirement. These 3 tax location decisions, made once, never revisited, Improve the effective return of the lazy strategy by approximately 0.5% to 1.5% per year, depending on tax bracket. On a 30-year horizon starting at $100,000, that annual improvement compounds into somewhere between $100,000 and $400,000 in additional wealth, from decisions made once, never requiring ongoing attention. Let me show you the complete picture of what the full lazy strategy produces, because I want the math on screen rather than implied. Starting balance, $100,000. Monthly automatic contribution, $750. Fund. Total market index fund, 0.03% annual fee. Tax location, 401k and Roth IRA maximized first. Tactical decisions made, 0. Adjustments to strategy, 0. Time horizon, 25 years. Expected annualized return based on historical S&P 500 performance, 9.5% net of the minimal fee. After 25 years, approximately $1,350,000 on a $100,000 starting balance, with $750 per month in contributions set to autopilot on day one. With 0 decisions made after the initial setup, the 25-year total of contributions, $225,000 invested over the period. The total wealth created beyond contributions, $1,025,000. More than $1 million created by the market while the investor did essentially nothing. The compounding worked. The automation worked. The absence of interference worked. The one thing that would have broken this outcome is the same thing that breaks most investors: selling during a crash, pausing contributions when the market felt uncertain, moving to safer assets when every financial commentator was using the word unprecedented. Paying an advisor 1% annually to manage the same fund at a cost 30 times higher than buying it directly. The lazy strategy is not passive in the careless sense of the word. It is passive in the engineering sense. It is a system designed to perform its function reliably, repeatedly, and without requiring human intervention. Like a furnace on a thermostat. Like a bill on autopay. Like an alarm set for tomorrow morning. You build it once. You leave it alone. It does what it is designed to do. Now let me come back to Priya and Derek, because Priya's story does not end at year 10. At age 45, Priya reads an article about index funds. She runs the numbers herself, comparing her actual 10-year return against what she would have received in a total market index fund with no tactical adjustments. The gap disturbs her. She changes her approach. She moves everything into a 2-fund portfolio. Total U.S. market and international market at Fidelity. She cancels the robo-advisor service. She sets up an automatic monthly contribution and tells herself firmly that she will not interfere. She mostly keeps that promise. She checks her balance once a year. She does not make any tactical adjustments for the next 15 years. At age 60, Priya has approximately $820,000 across her investment accounts. Derek, who kept the same strategy running for 25 years without a single change, has approximately $1,340,000. The 10-year head start that Derek had from doing nothing differently is worth $520,000 at the end of the combined 25 years. Priya changed course at exactly the right moment. She has a comfortable retirement. She built real wealth. Derek, who was never interested in finance and never tried to be, built more wealth because he had a better system running for longer, and because the worst decisions he never made were the ones that cost the most. If you are reading this as someone who has been attentive to your investments and wondering whether the attentiveness has hurt you, the honest answer is probably yes, a little, and the correction is not complicated. Stop. Set up the automation. Walk away. Not forever. Not in an irresponsible way. Rebalance annually between your stock and bond allocation if you have one. Increase your contributions when your income increases. Use your tax-advantaged accounts fully. These are the actions that add value. Everything else is financial noise. And the evidence strongly suggests that the person who builds the most elaborate system for filtering out financial noise is not the smartest investor in the room. They are the one with the highest balance at the end. I want to leave you with one number because I think it clarifies everything. The average actively managed fund charges 0.68% in annual fees. Fidelity's Zero Total Market Index Fund charges 0.00%. The difference on a $100,000 starting balance compounded over 30 years at 9% annual return is approximately $72,000. $72,000. Generated by the decision to change one number from 0.68 to 0.00. Made once, requiring no ongoing attention whatsoever. That is the laziness that builds the million. Not the laziness of never thinking about money. The laziness of thinking about it precisely once, building the right system, and then trusting it enough to leave it completely alone. Derek kept his father's note card in his desk drawer for 25 years. Put the money in a total market index fund. Set up automatic monthly contributions. Do not touch it for 20 years. Everything else is noise. It was the best financial advice he ever received. It cost him nothing. It was worth everything.